securities and tax regulations. The Insider Trading and Securities Fraud Enforcement Act of 1988. When should you trade based upon material non-public information? Never. When you don't get caught? No, wrong answer. How about when it's public? That's okay. So no trading based on inside information. People who distribute inside information upon which people trade can also get in trouble. So it's not just the trading on inside information that is bad, it's even just the sharing of the inside information that is bad. So all broker-dealers must have supervisory procedures specifically prohibiting the use of material non-public information. Whoever tells the information, so maybe a client told you something and you tell someone else and then they go and trade based upon it. All of you guys, even your boss, can get in trouble for that. The SEC has the right to investigate any person who has violated or is suspected of violating any of the provisions of the Insider Trading Act. The Insider Trading Act allows people to give information to the SEC. It's very similar to the newest program that the SEC has called the Whistleblower Program, where if the information leads to a fine being levied against someone under the Insider Trading and Securities Fraud Enforcement Act, the person, the informant, can get a reward in the form of a bounty. The Whistleblower Program does that as well. You don't hear about bounties very often anymore, but there are still some. If the SEC determines that a person has violated the rules and regulations of the Insider Trading Act, it may bring an action against the person in a U.S. District Court seeking a civil penalty. Under this act, the person controlling the incident may be liable for civil penalties. Okay, so the Insider Trading Act, civil penalties. So these are fines. The greater of $1 million or 300%, we sometimes call that triple damages or treble fees, 300% of the profits made or losses avoided. The SEC really loves to go after people for violation of the Insider Trading Act. So those are the fines. You may also go to jail if they find you guilty of a willful violation of the act. So those are criminal penalties. Criminal penalties may be imposed as well. So the greater of $1 million or 300% of the profits made or losses avoided. Those are the civil penalties. FINRA has conduct rules. I mentioned that before. So rules to make sure that we're following equitable principles of trade. All member firms must follow FINRA conduct rules. I don't expect you're ever going to have a question where they describe a rule and say, is it FINRA Rule 2320 or 2810 or 2915? They're not going to do that. I will reference as I go throughout the rules what rule it is, but I'm not super concerned about you memorizing those. Generally speaking, as you'll see when you do the quiz questions, it'll reference FINRA Rule 2320, variable contracts of insurance companies, and then go on and ask you a question. Okay, so don't get too hung up on, oh my gosh, I can't remember if that was an NASD or a FINRA rule. What was the number again? It's not that kind of a test. I will mention what the rules are. But unless it's something like Regulation D, you do need to know what that one is. It's the Federal Private Placement Rule. So if I've made a big deal about it, then of course you need to know those ones. So rules regarding variable contracts. So that's one of the things with your Series 6 license that you are allowed to sell. Variable contracts relating to. So we're talking about Life insurance, where instead of traditional whole life, the client chooses to buy variable life. With variable life, their premiums go into the insurance company's separate account and invest in the stock market. We're talking about instead of buying a fixed annuity where the premiums go into the insurance company's general account and promise to pay 3%, the client bought a variable annuity where the premiums paid in go into the insurance company's separate account and there is no guaranteed interest rate. So these are rules related to the variable contracts that you can sell. So it is FINRA Rule 2320. They have some definitions within this rule. Purchase payments mean the consideration paid at the time of each purchase or installment for or under the variable contract. A variable contract is contracts providing for benefits or values which may vary according to the investment experience of any separate or segregated account or accounts maintained by an insurance company. So variable contracts, not in the general account. They're somewhere separate account. And we'll talk much more as we go along about how variable contracts work. Affiliated member shall mean a member which, directly or indirectly, controls, is controlled by, or is under common control with a non-member company. Compensation shall include cash compensation as well as non-cash compensation. Cash compensation shall mean any discount, concession, fee, service fee, commission, asset-based sales charge, loan, override, or cash employee benefit received in connection with the sale and distribution of variable contracts. Non-cash compensation is any form of compensation received in connection with the sale and distribution of variable contracts that is not cash compensation, including but not limited to merchandise, gifts and prizes, travel expenses, meals, and lodging. So compensation includes both cash and non-cash compensation. Non-cash compensation includes things like merchandise, gifts, travel expenses, lodging, prizes. The term offerer shall mean an insurance company, a separate account of an insurance company, an investment company that funds a separate account, any advisor to a separate account of an insurance company or an investment company that funds a separate account, a fund administrator, an underwriter, and any affiliated person of such entity. So just some definitions to get us started. FINRA Rule 2320 requires that no member shall participate in the offering or in the sale of a variable contract on any basis other than at a value to be determined following receipt of payment in accordance with the provisions of the contract and, if applicable, the prospectus. Also rules under the Investment Company Act. So how you get paid when you sell a variable contract? Based upon the value of what the client is purchasing. So the price is always determined after you receive their payment. So following receipt of payment. And then as described in the prospectus. So remember, variable contracts, they're going to be, unless they're sold under Regulation D, which I'm going to assume they're not, variable contracts require registration. Anything that requires registration, when it's a new issue, which variable contracts would be, you have to give out a prospectus. So it's in the prospectus where it describes how you get paid. Payments need not be considered as received until the contract application has been accepted by the insurance company, except that by mutual agreement it may be considered to have been received for the risk of the purchaser when actually received. Generally speaking, they will not consider the payments received until the contract has been accepted by the insurance company. Transmittal rules. Every member who receives applications and/or purchase payments for variable contracts shall transmit promptly to the issuer all such applications and at least that portion of the purchase payment required to be credited to the contract. So if your client submits a variable contract application with money, when should you give it to the insurance company? Promptly, right away, as soon as you can. Selling agreements. No member who is a principal underwriter may sell variable contracts through another broker-dealer unless such broker-dealer is a member, so a member of FINRA, which we talked about, all firms are members of FINRA. It's the only SRO we have. I suppose with the exception of something like if the firm only trades in municipal securities, there is the MSRB, or if they trade in commodities, there's the Commodities Futures Trading Commission. But we're just trading in securities in this class. So no member who is a principal underwriter may sell variable contracts through another broker-dealer unless the broker-dealer is a member and there is a sales agreement in effect between the parties. Such sales agreements must provide that the sales commission be returned to the issuing company if the variable contract is tendered for redemption within 7 business days after acceptance of the contract application. They like that. So what do we have going on here so far? When you receive an application with premiums for a variable contract, submit it when? Promptly. And then if you submit an application with premiums and your client decides to tender for redemption of the contract, meaning they don't really want to do it, they change their mind, you can't keep your commission. So sales agreements must provide that the sales commission be returned to the issuing company if the variable contract is tendered for redemption within 7 business days. Return commission to issuer, insurance company, if contract is tendered for redemption within seven business days. I just wanted to make sure it was business days, not calendar. Within 7 business days. So they like that date. That means you have a chargeback on your commission, basically. You can't get paid a commission when they owned the variable contract for 7 days or less. That's basically what the rule says. Redemption. No member shall participate in the offering or in the sale of a variable contract unless the insurance company, upon receipt of a request in proper form for proper or total redemption in accordance with the provisions of the contract, undertakes to make prompt payment of the amounts requested and payable under the contract. So if your client wants to take cash surrender out of their variable annuity, the insurance company must pay when? Promptly. Promptly. Must pay promptly. Member compensation. So FINRA Rule 2320 says, in connection with the sale and distribution of variable contracts, no associated person of a member shall accept any compensation from anyone other than the member with which the person is associated. So as a registered rep, you can only get paid by your firm, basically, is what that rule says, except as described below. So there's always excepts. This requirement does not prohibit arrangements where a non-member company, that's the insurance company, pays compensation directly to associated persons of the member, provided that. So how can the insurance company pay you to sell this product? The arrangement is agreed to by the member. The member relies on appropriate rule, regulation, interpretive release, interpretive letter, or no action letter issued by the SEC that applies to the specific fact situation of the arrangement. The receipt by associated persons of such compensation is treated as compensation received by the member for purposes of the FINRA rules. and the record-keeping requirements are satisfied. No member or person associated with the member shall accept any compensation from an offerer which is in the form of securities of any kind. So the insurance company can't pay the member broker-dealer in securities. The insurance company cannot pay you, the registered rep, in the form of securities of any kind. That is prohibited. Member firms are required to maintain records of all compensation received by the member or its associated persons from offerers. The record shall include the names of the offerers, the names of the associated persons, the amount of cash, and the nature and value of non-cash compensation received. No member or person associated with a member shall directly or indirectly accept or make payments or offers of payments of any non-cash compensation. So to get paid in non-cash compensation as a general rule is not allowed. Except, okay, there's always this except. So what kind of non-cash compensation arrangements are permitted? So these are allowable, non-cash compensation. So under FINRA rules, allowable non-cash compensation includes gifts that do not exceed an annual amount per person fixed periodically by FINRA. So gifts that do not exceed an annual amount per person per year, annual. It's currently $100 per person per year. Gifts of no more than $100 per person per year. So if it's more than that, then it's a violation because non-cash compensation is prohibited. Okay, they like that. In order to receive this gift that does not exceed $100 per person per year, it must not be preconditioned on achievement of a sales target. It must not. It's perfectly allowable for your non-cash compensation to include an occasional meal. A meal, sometimes. A ticket to a sporting event or to a play. If they give you season tickets to the football team in your town, not okay, a violation of the non-cash compensation rules. So an occasional meal is okay. A ticket to a sporting event or to the theater or comparable entertainment, which is neither so frequent nor so extensive as to raise any question of propriety and is not preconditioned on achievement of a sales target. So how are they going to do this? Every once in a while on a test they'll say something like, they gifted you tickets to see, I don't know, Louis C.K. He's my favorite comedian. He's hysterical. He's kind of foul, but he's really funny. His tickets to his shows, generally speaking, they're like $45. He has this big rule about, if you're found scalping, he's gonna, scalp you basically. So if you were to be gifted 2 tickets to see Louis C.K., go, it's hysterical. $45 a piece, is that okay? Yes. And then they'll say something like, you were gifted 2 tickets to the basketball game. They have, each ticket has a face value of, let's say, $80. Is that okay? No, that would be a violation of the non-cash compensation rules. What if you're gifted tickets to a spring training game? The tickets have a face value of $45 a piece, but they had to buy them on StubHub for $150 a piece. Is that okay? I'm going to say yes. Go with the face value of the ticket. Okay, go with the face value of the ticket. So every once in a while they're going to ask something like that. What else is permitted? Payment or reimbursement by offerers in connection with meetings held by the offerer or by a member for the purpose of training or education of associated persons of a member, provided that record-keeping requirements are satisfied. Associated persons obtain the member's prior approval to attend the meeting, and attendance by a member's associated person is not preconditioned by the member on achievement of a sales target or any other incentives pursuant to a non-cash compensation arrangement. So this idea, like the $1 million round table, that kind of an idea, that's not what we're talking about. It's allowable if everybody who sells this issuer's variable products is invited to attend this meeting. They can pay for or reimburse you for the travel expenses related to the attendance of this training or this meeting. The location does need to be appropriate, though. If you live in Iowa, the meeting's not in Hawaii. Okay, that would not be okay. The location is appropriate for the purpose of the meeting, which shall mean an office of the offerer or the member or facility located in the vicinity of such office or a regional location with respect to regional meetings. That's okay. The payment or reimbursement cannot be applied to the expenses of guests of the associated person. So it's perfectly legal for non-cash compensation to include your travel expenses to go to a meeting in the neighboring state, but cannot pay for the travel expenses associated with the fact that your spouse went with you. That would be a violation. The payment or reimbursement by the offerer cannot be preconditioned by the offerer on the achievement of any sales target or any other non-cash compensation arrangement. What else is allowable? Non-cash compensation arrangements between a member and its associated person or a non-member company and its sales personnel who are associated persons of an affiliated member, provided that. Okay. What this is, this next little thing that I'm doing, is sometimes called, it all falls under allowable non-cash compensation, but they're sometimes referred to as sales contest rules. Okay. FINRA does not like this. So there's been, various different broker-dealers that have developed their own proprietary variable contract products. And then what they do, and when they get caught, they get in big trouble for doing this. Okay, so you will never want to do this, but I'm giving you an example of what is not okay first. So they say to their registered reps, go out there and convince all of your clients to switch from what they have already and put their money into our proprietary variable contract. Whoever gets the most money into this one specific product wins the sales contest. You can't do that. That would be a violation of the non-cash compensation rules. Okay. So what is okay? They can have sales contests if these rules are followed. The members or non-members non-cash compensation arrangement, if it includes variable contract securities, must be based upon the total production of associated persons with respect to all variable contract securities distributed by the member. So if the broker-dealer has 5 different variable contract products that they offer, 5 different issuers, if you will, you can't have the contest where you only win if you go to company A. It has to allow for total production with respect to all variable contracts. So that's one of the rules, total production. Total production. It's also required that the non-cash compensation arrangement gives credit for each variable contract security equally. So if there's 5 variable contract issuers that the broker-dealer represents, it's not double points for A. No, it's 1 point for each or 10 points for each or whatever. But there must be equal weighting to credits received for the variable contract. So total production is one of the rules, equal weighting. Equal weighting.